It is February 2020. Rohan is 32 years old. He has been investing 10,000 rupees every month in ASIP for 3 years. His portfolio is worth 4.2 lakh rupees. He is proud of himself. He is finally doing the right thing. Then the market crashes. In 6 weeks, his portfolio drops to 2.8 lakh rupees. 1.5 lakh rupees. Gone. Just like that. Rohan panics. He stops his SIP. He withdraws everything. He tells himself, I will re-enter when things stabilize. He never does. By December 2020, just 9 months later, the market has fully recovered, and then gone even higher. Rohan is watching from the sidelines. His 2.8 lakh rupees is sitting idle in a savings account, and the opportunity of a lifetime has passed him by. Here is the brutal truth. Rohan did not lose money because the market crashed. He lost money because he panicked. The market came back. Rohan did not. This is the single most common and most expensive mistake Indian investors make. And today, I'm going to make sure it never happens to you. Because the solution is simpler than you think. It just requires understanding 3 things. Lesson 1. When the market falls, you are not losing money. You are getting a discount. Think about it this way. You love buying shirts from your favorite brand. One day you walk in and everything is 40% off. Do you panic and throw away the shirts you already own? No, you buy more. The market works exactly the same way. When prices fall, your SIP buys more units at a cheaper price. The same 10,000 rupees that bought you 50 units last month now buys you 80 units this month. More units at lower prices means when the market recovers, and it always does, your returns are dramatically higher. This is called rupee cost averaging, and it only works if you stay invested. Lesson 2. The market has always recovered, every single time. The 2008 financial crisis, the 2020 COVID crash, the 2016 demonetization shock. Every time people said, this time is different. This time the market will not come back. Every single time they were wrong. Look at the Nifty 50 over 25 years. It has gone through 7 major crashes, and after every single one, it has come back higher than before. Not sometimes, every time. The bear phase is not the end of the story. It is Chapter 2. Chapter 3 is always a bull run. You just have to be there for it. But here is the real problem. Knowing this is not enough. Because when your portfolio is down 35% and your friends are all selling, logic disappears. Fear takes over. Rohan knew markets recover. He had read about it. But when he saw 1.5 lakh rupees vanish from his screen in a single month, his hands moved on their own. He redeemed. He stopped the SIP. This is not a knowledge problem. This is a temperament problem. And the solution is not willpower. The solution is structure. Lesson 3. This is the most important thing in this video. Listen carefully. Never put 100% of your money in the market. The ideal structure for a long-term investor in India is 70 to 30. 70% in equity, your SIPs, your index funds, your mutual funds. 30% in fixed income, PPF, FDs, debt mutual funds, liquid funds. Here is why this changes everything. When the market crashes 35%, your equity drops. But your 30% fixed income, it barely moves. So instead of your entire portfolio being down 35%, it is only down around 24%. That is still painful, but it is survivable. More importantly, it is psychologically manageable. You do not feel like you have lost everything. You do not panic. You stay invested. And here is the second superpower of the 70-30 rule. Life happens. Medical emergency, job loss, urgent family need. Something always comes up. If 100% of your money is in equity and the market is down 40%, you have 2 choices. Sell at a massive loss or suffer without cash. Both are terrible. But if you have 30% in fixed income, you use that money for the emergency. You leave your equity completely untouched. You let it recover. You protect your compounding. This is why the 30% is not just about returns. It is your calm during the storm. It is the reason you do not have to make emotional decisions at the worst possible time. Let me show you an alternate version of Rohan's story. Same February 2020 crash, but this time, Rohan had followed the 70-30 rule. His 4.2 lakh rupees portfolio was 2.94 lakh rupees in equity and 1.26 lakh rupees in fixed income. Market crashes. His equity drops to about 2 lakh rupees. His fixed income stays at 1.26 lakh rupees. Total portfolio, 3.26 lakh rupees. He has lost about 1 lakh rupees on paper. Painful? Yes. Catastrophic? No. His SIP continues automatically. Every month he is buying units at crashed prices. And when his car needed urgent repairs worth 40,000 rupees, he used his liquid fund. He did not touch a single unit of equity. By December 2020, his equity has recovered. And because he kept buying during the crash, he has 30% more units than he started with. His portfolio is now 5.8 lakh rupees. While Rohan version 1 is still sitting at 2.8 lakh rupees in a savings account. Same market, same crash. Two completely different outcomes. The only difference? Structure. The market will crash again. I do not know when. Nobody does. But it will happen. The question is, will you be Rohan version 1 or version 2? 3 things to remember. 1. A falling market is a sale, not a disaster. Keep your SIP running. 2. Markets are cyclical. The bear phase always ends. 3. Follow the 70-30 rule. Equity for growth, fixed income for stability and emergencies. Never 100% in the market. Structure your portfolio today, before the next crash, not during it. Because during the crash, it is already too late to think clearly. If this video helped you think differently about your money, like, subscribe, and share it with one friend who needs to hear this. See you next week.